if you crack that perfectly, you have built yourself a multi-billion-dollar company.
The main trend that you would see in the fintech space is
fraud is taking a whole different dimension.
the worst is really about to come now.
That to me is the big fintech opportunity.
What do you need to be a partner at a top tier VC in Germany?
I'm concerned. I think we have a huge problem with our hands.
Do you think anyone cares about anything else than financial returns?
Okay, that's it. This is how bad it looks. It's not as bad as we thought. It's the bottom. Let's start to rebuild.
Barbod Namini from HP Capital.
That's me.
Good to have you here, man. How is it going?
Yeah, very good. Thanks for having me. It's good fun.
It's a pleasure, actually, for two reasons. The first one is because you're the first VC that is coming to the show. So congratulations on this. and the second one, because I'm really interested in many of the things that we're going to walk through. And I also think that your experience and your position now, it's quite relevant for many people that could be now listening to us. So let's try to keep it as short as we can. I'm not promising you anything, but first of all, when we interview startups, we ask the same question, which is, what do you guys do? So in this case, it would be a bit similar. What is HP Capital doing?
Sure, let me give you the quick run through. So as a fund, we have been around for 24 years. We're one of the largest, most successful early stage funds in Europe. At our 9th fund generation, managed just under 3 billion euros in capital. And nowadays, the way we are structured is that we have an early stage vehicle and a growth vehicle. So we are stage agnostic as well as being business model agnostic, so as well as B2C as well as B2B. So very, very broad mandate with a platform strategy that can help startups throughout their lifetime.
Did it all started because I guess you don't get to 3 billion assets under management the first day.
No.
How did it start it?
So the story of HV is one of a single LP fund. We started in 2000 with one investor, and we were focused on German-speaking Europe, so the DACH region, and purely on consumer internet models.
Okay. Year 2000.
Yeah. And to be fair, by the time we got started, it was actually a pretty good time to start because it was as things went down. And as you know, it's easier to pick winners when valuations are lower than at the top of the market. Yeah. And consumer was pretty much what was happening in Germany. It wasn't like we were cutting ourselves out of tons of opportunities in B2B. The ecosystem was still a fairly small one, and there were a handful of VCs. The rounds were way, way smaller. And over the years, that consumer portfolio brought a ton of successes and allowed us to grow as a company, allowed us to raise more funds, allowed us to detach from that single LP structure and restructure ourselves as a multi-LP pan-European fund. So definitely a lot happened throughout the years.
That's super interesting because I can imagine, what would you think as a founder if you started a fund 2 years earlier, so in 1998?
Yeah.
Do you think you would still be here today as you are, or do you think it would completely change?
Yeah, I think, we'll see this live because the same can be said of if you started a fund in 2020, right? And we will see this happen. And the reality is, the first and the third fund are probably the hardest to raise. The first, because you have to convince LPs to give you money. With raising cycles being around every 3 years, by the time you raise the second, you don't yet have much of a track record. So LPs kind of have to commit to 2 funds if they back you. Mm-hmm. But by the third, you know whether the first is doing well or not. And obviously, if your first is just before the absolute peak of a cycle and you deploy it all at the peak, it's going to make that third fund very tricky. And we probably will see this in the 1920 vintage. There will be some casualties. We are already seeing some casualties. And that's just the reality of VC. It's risk capital. You are taking a lot of risk. And over long periods of times, it might sort of weigh out, and you invest some at the top, some at the bottom, and overall, if you're picking well, you return good returns, and then you can keep raising.
Did you start it also with two vehicles, like the early and the growth, or?
No, it evolved over the years. So we were an early only fund for the bigger part of our existence. And then a couple of funds ago, basically what we noticed is that we're great early pickers, and a lot of our companies, even at later stages, are still great investment opportunities. However, we weren't able to invest, and there wasn't as much growth capital in Europe. So more often than not, it was foreign VCs coming in and doing the growth rounds. And that was leaving a ton of money on the table, because from a multiple perspective, sure, you have a higher multiple on the early stages, but from an absolute cash perspective, if you're investing 50 million, do 3x, that's sort of 150 return. If you invest 1 million and do 10x, it's 10 million. So that brought us to expand our funds to include a growth mandate to keep investing in our portfolio companies. And with that doing very well, eventually with this latest fund generation, which is a 2023 vintage, we split the vehicles in two funds that can act independently, so that it's not only follow-on capital, but it's also first ticket in capital.
Yeah. That's nice. I just wrote down something that you said. We are great early pickers. What do you make great early pickers?
What makes us great? Well, I think it's more an art than a science.
I agree.
But by now, it's track record, really. I think one saying that always holds true in hedge funds, in public markets, is past returns are not indicative of future returns. That doesn't fully hold true in VC and early VC, because there is this self-fulfilling prophecy and this reinforcing mechanism by which, if you start your journey strong, and there might be some luck, there might be talent, whatever that might be, then those same people that you backed and went on to build billion-dollar companies, they come back in the ecosystem, right? Either as serial founder or as angels, whatever the case might be. And if you were the catalyst to their success and you had a good relationship with them, chances are they'll first come to you. So at the very early stage where things are not yet public and the information is not freely available, like at the hedge fund level, if you start getting all this proprietary deal flow of people coming first to you and then to someone else, and the pool of good entrepreneurs that you're backing expands and expands and expands, that sort of self-reinforces that being a good picker aspect.
I agree. Which we would be back at the most difficult thing is to build the first fund and the third fund, and to be able there. I like the disclaimer that would be different to what you always see in these investment channels, that is past return doesn't guarantee. In this case, it would be past returns will guarantee you this future.
It won't guarantee, but it makes it easier, of course, if you had, because you build a brand and a track record and your network, and it's a network-based business, right? It holds less true at the late stages, because again, at the late stages, it's more public information. So even if you have a direct link to the founder, some other fund might come and offer better terms, and given that it's about the money and it's public information, you might not necessarily win the deal in the same way that you would at the pre-seed stage.
Also, it's true, I think, that even when you're investing in public companies, it's not a science, it's more than an art. But I think the art is less.
Yeah, there is
the
data.
bigger they are.
Exactly.
Yeah. So that's why I guess. Okay, then you said also something interesting, that is we help them grow, of course, which I guess it would be related to the kind of the USP sort of HB. How do you help startups to grow? Yeah,
sure. I think if you abstract for a second, if a founder has multiple VC choices and he's in the privileged position that many people want him or her, it boils down to really three KPIs, in my opinion. The earlier you are, the more that personal connection matters. So that abstracts a bit from the fund you're in, because at the very, very early stage, you want a trusted partner, somebody that understands your business, that's going to help you, that's going to answer your calls. So maybe the great investor from the big brand that's 9-hour time zones away, as shiny and great as it sounds, might not be your best partner. So it starts with a human connection and a local human connection. Then the second part of it, so that's mainly up to each and every one of us, less to HV, but as a personal brand to build that connection with the founders. Secondly, there is the brand. Now, the brand, if you have a history of successes, of having IPO'd companies, etc., by itself is a bit of a signaling factor. If a great VC, great defined as big and successful, invest in your company, then you're more likely to get more attention, more follow-on capital, because people say, okay, that VC seems to consistently do well. I want to invest in the companies of that VC.
Yeah. Which is, by the way, sometimes it leads to this FOMO movement that there's always in VC that is horrible because of, then HB invested, so I have to invest, but I discarded this company 3 months ago.
Correct. And it's a factor and it plays. And then there is the third factor, which is exactly what you said about the more broader support. And that's where size starts giving you an unfair advantage, because the way the industry work is obviously that the fees are percentage based on AUM. So the bigger you are, the more money you'll have to build operations around your fund beyond just a pure VC fund. And at the size we're at, we take minority investments. We are not operational involved, so it's not a PE model. However, we were able to build a platform structure that has many functions that are there to help advise or to make connections, etc., to founders, whether that's in recruiting, ESG, IT, finance operations setup, etc. There is all that package that comes with it that somebody taking HV money gets for free, in quotes. Yeah. And then most importantly of all, you buy yourself into a network of 200 plus portfolio companies. And the reality is, as good as a sparring partner as the investment manager is, there's always going to be a portfolio company that went through the same struggles you are going to. And effect. It's that network that you get in that really also sets HV apart from many other funds in the region.
Definitely. Yeah. I like the third, the size, the unfair advantage is totally true. Yeah. Then there's a question that could be a bit more of a personal level. That is like, what do you need to make it to be a partner at a top tier VC in Germany?
It's a tricky question because it's a very unstructured. So VC as a whole is a very unstructured asset class. So,
and I know the question is misleading. I know, but
so if like it's way more straightforward in banking or in consulting or in a big corporate. You have this big pyramid structure. There are set milestones. There is criteria to get in, and it's pretty fixed. And then each 2 years something happens, and it's out or up, and it's more structured. VC starts with the DNA of whoever founded the VC company. So two VCs might be completely different in which profiles they want to start with. So let's abstract from partner. What does it take to get in even at a junior? Yeah. So you might have the VC started by sort of the PE-minded, banker-minded people that say, I know that a junior banker works 90 hours a week and I just want a very strong work ethic, and then I'm going to build the rest. And you get a fund that's a bit mirroring the sort of banking consulting world. And at the other end of the spectrum, you might have the founder whose philosophy is, well, great successes are done by visionary great disruptors. I don't care about academia. I don't care about what you did before. I want absolute out-of-the-box thinking, knowing that you might crash and burn because this job is not for you, or you might be that one person that's a complete outlier and saw a trend way before the FOMO lemming saw it, and you were the contrarian that picked it. And if you move between these two worlds, what does it take to get up the ranks? The easiest is to say, well, track record. If you pick good investments, then you're going to succeed one way or another. If that one fund is not the best fit for you, you go to one that's a good fit. And once you have a track record, you'll have plenty of demand. However, that takes a long time because, especially at the early stages, it's a 10-year process So what's the other side of it? Well, the other side of it goes back to the personal human aspect. How good are you at building a network? How early or in a preferred way do founders come to you? Do they trust you? Are you good at attracting junior employees once you start getting more senior? There is obviously fund management topics. You might be a very good fundraiser and bring money for the fund with LPs. So there are many different ways to travel that path once you're in. The most difficult part is getting in first place because it's a small industry. There aren't all those many jobs, and you have to really click 100% with the DNA of that specific fund.
That it also has to link really close to the, I guess, DNA of the LPs, right? Because at the end, you're doing the work for the LPs.
Yeah, yes and no, because ultimately the LPs obviously will tell you the things they don't want to invest in. So there might be exclusions, weapons, tobacco, alcohol, etc. But the LPs have a far more diversified view. They have a big portfolio. I mean, I'm talking about institutional LPs, not single family houses, but they might have a 10, 100, 200 billion sort of assets under management. They have a highly diversified portfolio in stocks, in bonds, in PE, in VC. And VC is a very small sliver of that. And within that small sliver, they diversify a lot as well. So it's rare to see high concentration among the GPs, meaning that ultimately they want monetary returns. So I would say the LPs don't sort of have that much of a say in the DNA of the fund. It's rather the other way around. Obviously, as a GP, you go and start pitching LPs, you'll attract the ones that believe in your story and like you as a person.
And that story, normally, is it all about financial returns? Or, like, honestly, do you think anyone cares about anything else than financial returns?
I think ultimately it boils to financial returns, but the story is, why are you better positioned to create good financial returns vis-a-vis a competitor? So it might be that you are an absolute specialist in an area and you say, I'm the biotech expert in this region. It might be that you have the best network, whatever the case might be. Now, there is obviously a secondary purpose to all of this, and that is that as you reach size, a portion, and it might be a big portion of your fund and LP base, might be pension funds and taxpayers' money. So to an extent, you are creating wealth for the elderly, you're creating wealth for a taxpayer. And that's in itself a noble cause, and one that we have fought strongly over the years to get more European money in. It all started with, initially a single LP in Germany, but then there was almost more US interest in European VCs than there was European interest. And now things are shifting and the mentality has shifted. And there are still problems with how pension funds are or are not allowed to invest in VC in Europe, but we are getting there. And then there is, if you ask me, or so, not the pitch to the LPs per se, but what makes me also love this job so much, to an extent, by being shepherds of capital of LPs in the startup ecosystem, we are also catalyst of a lot of job creation. Obviously, I wouldn't take the praise for that. It's all the founders that start. But with the capital, you sort of create a lot of jobs, and in a way, sort of you are part of that innovation creation for your own country and your own region. So it's a very, very positive feedback loop once you're in it, compared to day trading on the public markets. I have a portfolio to run. It's just numbers on the screen.
Yeah.
I don't really know what beyond did I make a positive return or negative. There is not much more to it in a way.
Yeah, the size or the side of the job creation, impact in the world, etc. I think is huge and massive and tangible in the VC, and it's something lovely that you don't have maybe later on, especially in public companies already.
Yeah,
that's awesome. Like, talking about VCs fundraising, I feel the need to ask you about the corporate venture capital. Like, what's your view, if there's any particular view that you may share related to corporate venture capital? Because you talked how you take the money from institutional large funds. And how do you see the role of the corporate venture capitals there?
I think CVCs can be great, but I think they take two paths. The ones that don't fully probably understand how to steer within the VC world, and the ones that fully get it. A lot can be done wrong, a lot can be done right. I think it all starts with expectation setting. So if as a CVC, the pitch is, I'm going to invest and I'm going to open all doors and your business is going to go from zero to hero because of me, that's setting unrealistic expectations on both sides, because the reality then kicks in that is the CVC just put a couple million in an early stage startup. It's a 100 billion company, makes 10 billion profits a year. A, they would not use a startup technology into the enterprise suite. B, even if they make 5x return, nobody cares. So then it starts being very quickly, well, you promise something you can deliver, and the other side saying, listen, why would we care? So that's something I've seen done wrong a few times. And the other thing I've seen done wrong is coming in thinking that that's an acquisition target pretty quickly. So if a CVC comes in with a strategic agenda as opposed to financial one, very quickly won't be allowed on cap tables anymore, because it caps the growth potential of the company if everyone knows that, well, that corporate has a right to buy it, so they will never let it become a multi-billion-dollar company. Now, the ones that act well and become incredible assets to any cap table are the ones that understand what's realistic and not, and effectively they offer a few things. On the one hand, if the investment they're doing is in the same space as the sponsoring enterprise, it's a stamp of approval. If I have a fintech and 3 bank CVCs invest, then the world says, okay, the banks did a DD and see it as a legit technology. Secondly, while you might not be able to straight away create business, a CVC can give or provide context to a lot of great experts, again, if the field is the same. So your VP engineering, your VP sales, whatever that might be. Thirdly, and this is more mundane, but it can help with simple things like, hey, we are trying to expand to New York, the corporate has an office there, you can sit at our offices, or our legal team can tell you how to set up a subsidiary. The things that are super easy for the corporate and very hard for the startup. And if you package all that with the financial view, i.e. act as a financial investor as opposed to strategic, it becomes an incredibly powerful ally to have. So I think there are CVCs that play that game incredibly well.
Do you want to name a few? Just
No,
in case, or just one?
I don't want to name, because then the ones that are left out say you put us in the wrong bucket. But ultimately,
yeah, okay, that's fair. Obviously, I'm a defender of the corporate venture capital model, and building on top of what you said, which I think is fair and is right. Sometimes there's this line that you have between what's the core of your business as a corporate and where do you want to go. So imagine that you're building cars, but you want to go also to entertainment, because if your cars are going to be self-driven, then you're going to need to add some entertainment in the car while the driver is there, right? I'm just putting a random example. So the line starts to get super blurry, because it's like, oh, why X company would invest in these entertainment companies? Like, well, they want to go there. Like, okay, but maybe today in 2024 they are not adding any value to this startup yet, but the value is more for the corporate in that matter. So I think the line for the corporate sometimes is a bit thin.
But I think they can still add all the points I said. I mean, they can add support. They still have experts that have 20 years experience. So there is, even if you're not in the same sector, once you have a big enterprise behind you, there is going to be a lot of help you can provide to startups.
Yeah, I do think so too. And do you have any, let's say, talking about now about portfolio companies that you may have already, is there any particular company that you want to showcase as an example of, we did great with this company because this and this and that, and when we found them, it was very minor company? Like, I want you to walk us through a whole process.
Sure, I can tell you a bit what my sort of way of investing is, and it's not the same for every investor. So I always say I would place good VCs on one of two extremes. You can be incredibly good with your network, put a lot of time and effort in nurturing that network, getting the very best angels to trust you, and then have that as your filter to what you're going to do, well knowing that with all the time you put in, the stuff you're going to get is good. So you're generalist, but you're network heavy. And obviously you understand the topics, but the most of the... At the other end of the spectrum, and that's where I put myself rather, is that sector expert where you say, I go top down first, I come up with my own thesis. On the back of that, I start drilling into the market. And obviously, I also have a network, and I see what my network gives me, but I don't rely solely on the network. I also cold email the rest to find the very best team within that market, and then I try to get into that team. And that process obviously comes with then, once you are in front of the teams, you can click very quickly because you know the space so deeply and so well. Now, obviously, both types have to have characteristics of the other. One has to understand the concept of the other, still has to have a network. In the middle, it's where it gets dangerous, where you have a so-so network, you're not really into the topics, and you kind of, without having done too much research, say, okay, this sounds good enough. And now, coming from that top-down first, bottom-up next, I'll pick a company where it's sort of in the middle of its journey. So it's not two people in a garage anymore. It's not IPO'd yet. And if we go back a few years, when and I'm the fintech partner, so it's going to be a fintech topic. When open banking started to become a topic, PSD2, so what is it? That's European legislation and UK as well that effectively forces banks to allow third parties with the consent of a customer to initiate payments and to get bank account data.
Massive change, by the way, in the sector.
Why is it super important? Because the previous model was a siloed one where a bank would spend a lot of money to acquire you as a customer, but then they would sit on the data. So they were the only ones realistically being able to give you other products that would then upsell.
Yep.
If that data is all at once for free, it democratizes the whole financial space and everyone can offer products to everyone. Now, I thought that's going to be a huge change in the European landscape. It hadn't launched yet in Europe. It was just in sandbox in the UK. So by that logic, I started speaking to all the founders, and there were many, because when the space is big, many people try to build a company in that space. Yeah. And through networking, experts, etc., I eventually got introduced to a founder called Stefano, who was founding a company called Yapili. And they were literally, I think, 4 or 6 developers in a co-working space, in a shared co-working. They didn't even have their own office. They had just raised a small angel round. And it clicked straight away because he pitched me what my view was as well. And that's not always right. But by the way, taking one step back, if you have a thesis, I see hundreds of teams every year. And if I then do this approach and drill down and speak to 5 companies and none of them is particularly impressive, and particularly impressive without wanting to be offensive, I just have a benchmark in my head, right? If I see thousands, I kind of know. Yeah. Then I know that I might be wrong with my thesis, because if the thesis is good, you will have amazing teams working on it, because the masses are smarter than you are. So if something is big and has potential, very smart people are going to start tackling it. And as a VC, you can then quickly say, okay, was I right or not? Yeah. If everyone in the room is smarter than you might be right, because you say, okay, there is something here. So it clicked, and that's when we said, listen, very easy, we can join the angel round, we can do a new round. And that was the start of a process that led us to do the angel round, then the seed round with Local Globe, which is a great UK fund, then the A round with Lakestar and HV, always supportive and investing, then the B round with Sapphire Ventures. And they became sort of a Series B company. A couple of weeks ago, they announced that they're going to be the exclusive partner of Alipay in Europe.
Massive.
They are becoming that enterprise darling where enterprises go to them because they are a pure infrastructure player, so they don't compete with the products the enterprise are offering. And we're in the middle of the journey, but it's fun, and it has its ups and downs. And we went through the madness of 2021. We went through some cost cutting in 22. It's all part of the journey. But yeah, that's sort of one example that followed that logic pattern. And obviously, if I go back 20 years and the things that really made all the way, we were investors in Zalando, in HelloFresh, in Delivery Hero, in Flixbus, all companies that are either already IPO'd in the DAX or pre-IPO, that they precede a bit my time. Yeah. But those are the ones that made it to the end of the journey, effectively. Or not the end of our journey with them, and the beginning of their public life.
I got a little bit hooked with what you said at the beginning when you met Stefano. So it's what do you need from a startup to draw your jaw?
Yeah. I think it's cliche to say it's all about the team. To me, yes, that statement is true with a caveat. The best team in a very small market might result in a worse VC return than an average team in a huge market. So the best team might still be building a nice company, but that's not a VC company. So it always has the combination. It has to be the combination of great team in a big market. And the big market might not be big today. Open banking was zero when we invested. There was nothing. But that idea that it is going to become a huge market. Because you always have to go by assumption that you're going to carve out a little percentage of that market, and then it's a percentage of what number. Whether an entrepreneur is good or not, that's more gut feel at the early stages. You can't know. Obviously, you have serial entrepreneurs that already proved themselves, and there you have some data points. And the counter argument to that is, yes, but now they're 45, they have kids, so they are more risk averse than they were when they were 20.
Good point.
So there is a bit of both. I tend to invest in quite regulated industries of fintech. So for me, the perfect profile is not the out of university, because more often than not, the regulators don't like them, and they might have trouble getting licenses, etc. And you're not allowed mistakes towards the regulators. So often it's founders with probably 10 years experience or some experience that gives me the comfort that they're not going to do mistakes that gets us in trouble with the regulator. On the consumer side, it might be very different, because it's very often, if you look at the huge successes, it was the very young ones that saw a new consumer trend popping up, and maybe I wasn't aware of it because I'm already too detached from what the teenagers are doing today. So, there is no perfect founder per se. It has to be a good fit for the industry, and it has to be a big industry.
But you draft a pretty nice sketch of the founder, because it would be like, I don't want it brand new, but I don't want it too, let's say, old. So the risks are too high for him or her. So you drafted something that is quite interesting. And when, of course, we all have to think that your field of expertise is fintech. Yeah. So, of course, when you say regulators, you're talking about the real regulators that they can really completely ruin a business.
Yeah, in finance, in healthcare, they can just shut down your business.
Same, that's right. And you mentioned something very interesting, that it was the market. So when you say, I want a huge market, these blue oceans, right? Yeah. But you also said it was zero, the market. So my question would be, do you need like a market that is not yet there, or would you feel more comfortable with a market that was already developed, which has pros and cons?
So both work. I think in the market that's not yet developed, you are taking a bet on the future, whether it's AI, whether it's autonomous driving, whether it's many of the fintech trends, because you say, I'm confident enough that this technology or whatever it might be is needed and is a natural evolution from where we are at. In the existing market, what's more important then, it's not the size of the market, but the technological innovation within it. So if it's a big market dominated by legacy players that work less and less for today's consumer, then you say, well, I'm betting on the technology, innovation, disrupting and eating part of the pie. Maybe the pie is not getting bigger, but it's a huge pie, and I envision a redistribution of the pie. The third potential bucket is regulatory change. So for instance, when we invested in Flixbus, within Germany, buses were not allowed to go from city to city. Buses were allowed to go from Germany to another city abroad, but there were no bus lines between cities. Why? Because it was the state monopoly of the train system.
Wow.
Now that got deregulated, I think in 2012 it was. So that all at once opens up a new market that's a secure market, because it's a no-brainer. You can just look, US, Greyhound goes, it's a big market. So you have the certainty that big market got created overnight, and then you try to ride the regulatory wave. Similar stuff has happened in healthcare, remote visits, sort of digital prescriptions, these are all on the back of regulation.
Yeah. Okay. Without leaving the startup perspective again, going back to Stefano and when you met them, etc. You talk about the team, you talk about the market. Then as it grows big a little bit, like how important is, like, imagine that you're burning 2 million EBITDA. It's a company that is near 2 or something. How important are the unit economics at the beginning when you really need to burn cash to acquire customers?
So I think they get more important with time. The bigger the company, the more, the higher the letter in the alphabet, the more you abstract from the team and look at the hard numbers and hard facts. Because also a late stage investor might come with a sort of frame of mind that says, well, the founder was good to get the company to this stage, but he or she is not necessarily a good CEO for a big company. I can just put in sort of professional CEOs that's all they do. That middle phase is indeed the most difficult part, and it changes massively from space to space. So, for instance, you had the models in the past when social media became big. The model was literally size is all that matters. We are eventually going to find the business model. Those were models that, for a reason, did not initiate in Europe because there just wasn't enough money to allow for that to happen. You needed billions and then figure out a business model. So it kind of only works if there is a very, very, very deep VC PE community that fuels that. Which brings us then to and that's a bit the extreme. And yeah, for instance, foundational models of generative AI, same thing. OpenAI had to raise 10 billion plus.
Yep.
But now it's doable in Europe as well. So we saw Mistral. We saw sort of similar cases across Europe popping up, raising 200, 300, 400 million at seed, at A, at whatever it might be, because people say, yeah, there will be a strong enough business model. For everything else, it's a milestones-based approach. If you have a clear business model, if you know kind of how it works, then you say, to reach X, I'm willing to allow this much burn. To reach Y, I'm willing to allow this much burn. And if the two things are completely out of whack, then you need to rethink. It's not that you can't allow infinite burn to not achieve the goals. Then you say, okay, this is not working. Then we have to cut this and regroup and rethink. But it's strictly milestone based, it's strictly KPI based, plenty metrics to look at, and then on a monthly basis you get a very good insight into the health of the company and the health of the growth.
There was another question that pops out in my head while you were talking about, and of course, knowing the whole background that you have. There's a question that intrigues me. That is, what startup will you build today?
Yeah, I'm very much into fintech, so it's gonna be a boring list of things that don't sound cool and exciting, but are needed. So one of my theses is that we went through probably 10 years within fintech of front-end innovation, and what I need by that is better apps, better customer engagement, better customer acquisition, but a complete lack of product innovation. And what I mean by product is financial products. So if you build a neobank, but you're restricted by the infrastructure of a legacy bank, then the products, the mortgage, the lending, the credit card, they're not going to be invented from scratch. They are going to be based on what exists. Then we started, and we are in the middle of that back-end innovation. Now, the back-end innovation means that I'm not one that says banks are going to all die out. I think banks are going to play a very important infrastructure role, but I don't think they should be doing the front part of the business, so customer acquisition. And nobody wants to walk in a bricks and mortars bank.
Yeah.
Websites are not great. So the brands with whom I have the most interaction with that then need me to get a financial instrument are consumer brands. I'm buying a phone, a laptop, I'm booking my holiday. For all those, I need financial products at the back end, whether it's a credit card, whether it's a loan, etc. So those should be the ones selling me the product from the balance sheet of a bank.
Yep.
So for that, you need back-end innovation. So startups in the space of core banking software, banks have to rebuild themselves to be modularized, API accessible, and on the cloud. So super long sales cycles, but extremely high ACVs. There are a few, less than a handful. There is still space to innovate there. Embedded finance as a category is still, there are a couple companies that are doing well. We're invested in Solaris Bank as one of the leaders in Europe, but there's still a lot to be done. So to move fully to a world where any brand can then become the distributor, there is still a lot of potential there. So I see that as another bucket that, while not new and novel, it's still one that has a lot of potential. Vertical SaaS within financial industries. So doing something really well and then going away from Excels and phone calls and letters and this and that. So you can specialize on a, let's call it niche in quotes, but it's not a niche. Like mortgages are not a niche. They are multi-trillion-dollar business, right? So if you crack that perfectly, you have built yourself a multi-billion-dollar company. Payments, I think payments reinvent themselves every decade or so. We are in the midst of a reinvention of payments because we are moving from a world where the rails were purely credit card rails to a world where it's credit cards, it's account to account through open banking, buy now, pay later is a mode of payment, digital assets, whether it's crypto or whether it will be central bank issued digital assets. So all these need new rails. So we're investing in a company, RevUp, that does that. It's trying to reinvent all the rails. So I think there's a lot of space on that. And then going lastly to maybe the sexier part of the financial industry, obviously AI is bringing a lot of disturbance, so to say, in the highly regulated and compliance-heavy world of finance, because fraud is taking a whole different dimension. If you can have hundreds of different AI personas attacking and trying to defraud a bank, you all at once need a completely new technological suite to defend yourself against it. And that might be the one where the true developers that are looking for new challenges might get more excited, and it's a huge space as well.
Well, I mean, I think that you mentioned a lot of them that are super interesting to me. I'm thinking I was missing, and I don't know if you feel they are. I'm missing two. So the first one would be related to what you said about fraud. That would be the quantum technology. So meaning, so if now I have a, let's say the bad guys will have access to quantum technologies, they will be able to crack all the passwords and everything way easier. Therefore, it needs to be develop a layer of quantum security. That's one that I don't know if you agree, and the other one would be about crypto. But I will leave this one here, just as we were talking about now. But
so no, quantum definitely, and we have invested in quantum companies. I see it less as a fintech topic and more of a generalist.
Yeah, true.
So
true.
By all means, it's a far deeper tech type of investment. It needs a special type of founder and a special type of investor to fully understand it. But indeed, it's a space where a lot of money is going into. Crypto, we keep being excited by it. needs to fit well within the risk profile and everything of the fund. But we do crypto investments, and I keep being a long-term bull on the space. I'm less of a decentralized, anonymous type of renegade because I while that was the start of it all, for it to really become a mass market product, I don't think the average Joe cares about anonymity versus security. So the average person will only start using crypto as a payment method once it has the same security as his or her bank account. He doesn't want to know that if his wallet gets hacked, he lost all his money. He wants to know that if bank account gets hacked, he gets the money back because it's insured. Yeah. So once he gets that level of security, and it means going away from pure decentralization and anonymity and going to a world in which you use all the underlying technologies, the blockchain and issuance of coins, etc., but probably in a more centralized, protected environment. And that, to me, is the big fintech opportunity. I'm not saying that there isn't a huge world of opportunities as super exciting companies that act in the classical crypto sense, but from a fintech standpoint, I think that's going to be the flip point.
But wouldn't you be killing the essence of crypto if you says, look, I love this space, but don't do it decentralized? It's like, man, we wanted it because it's decentralized.
Yeah, I think there's going to be two worlds to it, right? There is going to be the decentralized one, and that to me will have, again, niche is not the right word. It's not a niche. It's not small. Yep. But in the grand scheme of things, it's a niche in terms of percentage of the population. So there's going to be that. And then there's going to be mass market digital assets. And mass market digital assets, to me, have to have regulation protection around them. And we see now Bitcoin ETFs going live and potentially central banks issuing their own digital currencies. There is no reason why there shouldn't be a digital euro, and we move away from paper. So those are really mass market adoption use cases where I say, if you invest in the infrastructure technology thereof, you can build huge, huge companies.
Is there in this space anything you also particularly like? I'm trying to put together all the points, because when you said there's a lack of financial products, I agree, and it was actually a view that I didn't think of. And I love the fintech space, and I was like, true, this is neobank, but there's still, like, do you have your paycheck here? This is your credit card. This is your bank loan. How do you envision these new financial products? What are they related to?
I think the innovation will come in the form of hyper-personalization. So at the core, the main financial product is a loan. No matter how you want to skin the cat, that's where it boils down to. Whether you're buying a home using a credit card or buying a laptop, that's sort of the core product. Now, we live in a world where both in insurance as well as in financial, you get bucketed into a risk category. You get given a certain limits. You get given a certain interest rate based on if it's a house, on the location, on your salary, etc., etc. And credit scoring is flawed in its essence as well, because you might have a very high salary, but then many costs every month that don't get picked up by credit scoring agency because they don't go into your bank account. Whereas open banking can say, okay, yes, you earn 20,000, but it looks like you have 5 Ferraris on a lease, so you have €0 to spare. And that hyper-personalization will really change how fintech works, because it's all on the fly, hyper-personalized, without 200 back and forths. It's timely, and it changes your whole experience. And I think that's at its core the first and big innovation stage we have to go through.
Nice. So you would say, like, as a highlight, the main trend that you would see in the fintech space is hyper-personalization.
Yeah, once the backend is there, and is able to connect to data sources real time, use open banking, use other providers, then hyper-personalization becomes the ones that crack it will have a huge advantage vis-a-vis any other bank, because, or let's put it this way, if you're a smart then consumer, if personalization gets you a better deal, you will go to that bank. If being bucketed within a risk category gets you a better deal, you go to another bank. So if you're the one that always has the accidents, then you're better on in a bucketed car insurance as opposed to the hyper-personalized one. But
yeah, true. But maybe you're good with something else that the bank can benefit from. So I guess that you have to do some kind of deal with that. There are two other topics that I wanted to talk with you very, very quickly that I'm particularly interested in. I think that is the common interest of many people. So the first one that relates also to the fintech is the debt problem that we have. And I know this is a bit far-fetched, but we are at the end of the interview, so we can allow ourselves to talk a little bit more freely. And when I see the debt per GDP per countries in Europe and in US as well, I'm like, well, it seems that something is not working, and I don't know how it's going to be solved. What are your thoughts in this wide topic?
I'm concerned. I think we have a huge problem in our hands, and we don't have the demographics to really claim that
that's a good one.
We are going to work ourselves out of it, because being aging populations, it kind of gets worse, not better. Mm-hmm. And we can hope that technological innovation gets us out of the hole, in that it increases productivity, GDP, and all, and we get into the surplus state of managing to ride out of the debt wave. But as we speak, structurally, we are not in a good place in the Western world, so to say.
Yep.
And I'm a macro guy, and I love macro, and sort of, if you even look at the past 20 years, you could throw away everything economics students learn, because when I started sort of my career, I was giving some maxims, some rules of engagement. Interest rates go up when the economy heats up. Interest rates go down in a recession. Bonds and equities are a good hedge to each other because they move inversely. A 60-40 sort of stock bond portfolio seems to be a safe enough one, etc. And then all at once, government started having a lot of sort of involvement in the sort of overall economics. And from the great financial crisis 2008 onwards, everything went out of whack. So we have had a decade plus of zero interest rates, but at full employment and booming markets. So bonds and equities were up, interest rates were zero, everyone was doing well. There was no more this up-down recession boom. And then a lot of today's investors grew in that world, right? And that's what they saw and what they know, and they had never gone through a recession. And that you can see it also today in VC, because there is that hope. And then COVID hit, employment spiked, so you thought we were going through a recession, and instead we went into a bubble of everything. So biggest asset bubble, cross asset bubble that we have probably seen in our lifetimes, because 2000 was just tech, 2020 was everything. So you're like, okay, so how do I engage in this world? Well, in that inflation all at once comes at a multi-decade high, first time at double digit in decades, and rates go up at the highest pace ever in Europe. And then you're like, okay, this is gonna break our back. What happens? Well, we're still at full employment. There are shortages in employment. And yes,
S&P went up 30% or 20%
there is a sort of recession, but not really. Indices are at an all-time high, but at the most sort of consolidated around a few stock as they have ever been.
Yeah.
And you're okay, so how do I invest in this environment? Inflation comes down, and for the first time in our lifetimes, geopolitics all at once are a topic. So
Yeah.
we have gone now through 2 decades where it's damn hard to invest based on macro, because you genuinely cannot predict what today's situation means for the overall asset classes. But on the flip side of that, we are at the dawn of again, great technological innovation. We have had some true sort of step jumps in what technology can do. With COVID, if it wasn't clear enough, the governments finally saw how important it is to be more digitized, because it was a disaster. Healthcare, education, everything was a mess. So governments are backing it. You have a lot of dry powder, but you have nervousness because you don't know what's next. Is it a war? Is it a nuclear war? Is it what does inflation do? What do we have energy next winter? Macro all at once started to bombard every investor, despite those investors being completely detached from macro in theory. Yeah, it's an interesting world we live in.
I think that we should just give a disclaimer that we're recording this episode on February the 1st. So actually this is the earnings week. So the top companies are going to report earnings. So if something goes weird, we don't know yet. So maybe already the S&P is not at all-time highs, because yesterday I think it actually went down because the Fed said that they were going to maintain the interest rates quite high. It seems, and they are not expecting to lower it down in the next meeting. But yeah, still it's a lovely time. It's very interesting to check it from the first point of view.
At some point, the consumer spending's got a break, right? Because it cannot be infinite. I mean, you see it from holiday prices, hotel prices, airline prices. I mean, there has to be a cap. And then we reach that. There's going to be bad earnings. We're going to go through a couple tough quarters. But the paradox in that might be that might actually be the ignition spark for VC again, because you say, okay, that's it. And there's all this dry powder, and there is nothing scary coming along anymore. This is what we predicted. This is how bad it looks. It's not as bad as we thought. This is the bottom. Let's start to rebuild.
Yeah.
At the moment that bottom gets shifted from quarter to quarter, where I say, well, is something bad coming, or things look pretty okay, kinda.
I got the feeling that we are always, and this is a human being thing, we're always thinking, okay, the worst is really about to come. Now. You keep I got that feeling, even though sometimes I remember like last year when we were in the bottom and the S&P was already down like 20% or something like that, you had the feeling that, okay, it seems that it's going up little by little, it seems. Yeah. But sometimes you're always scared of, but the interest rates and the Fed and the wars that are popping up and what's going on. But anyway, and
tough times.
The last thing that is super related to this is just more a prediction. I know you're not let's say, how can I say, a guru or anything.
Let me bring out my crystal ball.
You don't pretend to be. It's nice to have your opinion, and this is what it is about, to have opinions. So the investment universe in Europe, meaning, I read a stat the other day, I don't remember the source. I think it was like 8% of the Europeans, I think it was 8, or around 10, they invest in something, right? Bricks aside, like the houses aside, right? They invest in something related to the stock market or VC, etc. In US, it was 50%. So I always tend to think, are we going to copy the US guys in terms of more and more people will be investing not only in stocks, which as well, maybe crypto was an entrance for many people, I guess, I don't know, younger generation. Many people will invest in stocks, and therefore also why not in VC? Because at the moment you wanted to have a really diversified portfolio, you say, I'm going to invest in stocks bonds, but also why not? I'm going to drop a little bit to alternative assets like startups. Do you think that the Europeans will do that, or is it something in the nature that says no?
No, I definitely think they'll do it, and I think it's less to do with nature and more to do with tax law. So if you go back to the US, why is the sort of participation so high in the equity markets? It's because the way their pension system works with their 401ks is that if you're employed, you can, in a tax wrapper, invest, and it's not sort of punting on penny stocks. There is obviously a control on what you're allowed to invest, but if you invest, your pension in the stock market gets matched. It's highly tax incentivized, and every research data on Earth leads to over 30 years, you're gonna make money. Because by definition, the index is made of companies that if they are too non-profitable, they get kicked out of the index. A profitable one gets put in. So at the very least, the profits have to get added to the index price. And yes, there's ups and downs, but over 30 years. And that always sparked a culture of, okay, I now get it, and I also invest in other stuff. Now, Europe has resisted that for this, I don't know why, belief that stocks are a risky asset and it's much better to give the money to the government to not do anything with it. But we are reaching the breaking point because of our demographics. So there are already countries, Southern Europe, to start with, where they cannot cover pensions anymore. Now, the only way to get out of that hole is to start introducing tax legislation that in a way mimics what the US does. In the UK, you have the ISAs. Once a year, you can invest, I think, up to around £30,000 tax-free. So introduce legislation that's going to effectively force people to do it, because it would be stupid not to. And we're going to have a transition phase where the two models have to coexist, because there's going to be the people getting into pension that says, well, I paid all my life, I now want my money. And there's going to be the younger generation that says, okay, now that I have the choice, this is the better one. It's going to take a long time, so it's not something that's going to happen next year or the year after, but that effectively then will be the foundation of at least a decade of great equity returns in Europe, because you will have so much more money flowing into the equity market all at once that in itself will support the markets, give more firepower to the companies, and then shift the culture, so to say. And should a private individual invest in alternative assets? Only if he doesn't need that money. So I think that's the last step of your wealth creation. I mean, you have to have made enough, because it's illiquid. It's sort of, you have to lock it up for 10 years plus. The returns can be great, but again, you have to forget that you have that money. So it's not something that your average blue-collar worker should do.
I love that you take it down to earth immediately. Yeah, it's about taxes. It's not about taxes. Yeah, I love. I mean, I don't want to keep you any longer, because besides we have to go for lunch.
Yeah, but we promised a lunch.
The Bavarian lunch. But it was such a pleasure. I don't know if you want to say anything else. You're open to whatever, if you feel that there's something else that you want to say or discuss.
No, listen, it was a great chat. As you notice, I love talking and speaking, so it's harder to get me to shut up than to talk. For whoever sees it, you know who I am, where I work. If you have an early stage startup and are interested to chat, always looking forward for inbound. Otherwise, we'll go for lunch.
That's awesome. Thanks a lot, Barbod. What
Thank
a pleasure.
You.
Perfecto.
Yes.